Imagine a company, right? Market value, $8 billion. But then you look at the revenue and well, it barely registers. And losses, hundreds of millions. So is this some kind of genius long-term play on brand power, or is it a valuation just completely, floating free from reality?
Uh-huh.
Today, we're taking a deep dive into exactly that kind of situation. And honestly, by the end, you might find yourself questioning how markets even value certain things.
Welcome to the deep dive. Our mission here is pretty simple. Cut through all that information overload, slice through the noise, and just give you the essential insights, the nuggets you really need to be well-informed.
That's the plan. And for this deep dive, we are digging into an intrinsic value analysis of Trump Media and Technology Group Corp. Ticker is DJT. This is as of September 2nd, 2025. And the share price we're looking at is $45.10.
Right.
So our goal, we want to dissect the business, the management, the financials, all those risks, so you can get a better handle on what its intrinsic value might actually be.
Okay, lots to cover. Let's jump straight into part one, unpacking the fundamentals.
All right. First up, chapter 1. The business of DJT, a digital platform at the political nexus. So what's the core operation here?
Well, fundamentally, DJT's main thing is the Truth Social microblogging platform. You can think of it functionally, very much like X, what used to be Twitter. Place to post, engage, connect.
Okay, standard social media function.
Yeah.
But how do they make money? That's always the question.
Yeah, and that's where it gets interesting and challenging. Their monetization strategy is advertising-based, specifically programmatic ads.
So automated ad buying.
Exactly. Which often means it's about quantity, cost efficiency, maybe not so much about perfect brand alignment. And this creates a really significant structural issue for them.
How so?
Well, look, major corporations, the big brands with reputations to protect, they tend to be very hesitant, very shy about placing ads next to politically controversial content.
Right, makes sense. Risk aversion.
Totally. So that pushes Truth Social towards, let's say, lower quality, definitely lower priced ad networks. And that hits their revenue potential hard, really hard.
So if the ad model is facing these headwinds, are they looking at anything else? Any other big plans to bring in cash?
They have mentioned plans for a subscription streaming service, TMTG Plus, they're calling it.
Okay, TMTG plus Fast. What's the status on that?
Well, here's the key thing. As of now, September 2025, it's purely conceptual. I mean, there are no launch details, no content library announced, no pricing structure, nothing concrete.
So any revenue from that is just speculation at this point?
Pure speculation. It's an ambition, maybe a future goal, but it's not contributing anything to the bottom line right now.
And the tech behind Truth Social itself, is it their own? Did they build it from scratch?
No, that's another important point. The core tech infrastructure isn't proprietary. They actually rely pretty heavily on Rumble for their cloud hosting and other essential services.
So they're dependent on a partner for critical functions.
Exactly. Which, can mean lower upfront costs, sure, but it also means less control and that dependency you mentioned. It's a trade-off.
Okay, let's talk users. How many people are actually using Truth Social?
The estimate is around 8 million monthly active users, MAUs.
8 million. How does that stack up?
Well, you gotta put that in perspective. It's a tiny fraction compared to the giants. I mean, Meta, X, they have users in the hundreds of millions, even billions.
Oh, wow. Okay, so very niche then.
Very niche. Truth Social serves a specific, let's say, highly engaged segment of the American political right.
So what's drawing those 8 million users in? What's the core value proposition if it's not mass appeal?
It seems to be mainly two things. First, and this is probably the biggest one, it's the exclusive primary social media channel for Donald J. Trump.
Right. Direct access.
Direct, unfiltered access. That exclusivity is a powerful draw for his supporters. Second, it positions itself as a platform for free speech, sort of a cancel-proof zone, appealing to people who feel maybe mainstream platforms are censoring them.
Which naturally brings us to competition. Social media is crowded, it's tough.
Oh, absolutely. It's a mature, intensely competitive industry. You've got direct rivals like Gettr and Rumble targeting a similar demographic. But then there's the overwhelming indirect competition from the behemoths. X, Facebook, Instagram, TikTok. These guys have vastly greater resources for R&D, user acquisition, and crucially, for attracting those high-value advertisers we talked about.
Which brings us back to the money per user, this ARPU problem, average revenue per user. What does that look like for DJT?
It's stark. The estimated ARPU for DJT is approximately $1. $1 per user.
$1? How does that compare?
It's exceptionally low. We're talking 10 to 50 times lower than its larger competitors in North America. And look, this isn't just because they're smaller. It points to a fundamental structural weakness in monetizing their specific user base with their current ad strategy.
Okay, so lots of challenges. But do they have a competitive advantage? A moat, as they say, something unique.
They do have one very significant asset, yes. It's undoubtedly the brand, the voice, and perhaps most importantly, the exclusive social media content of Donald J. Trump that is almost impossible for anyone else to replicate.
That's the core asset.
It creates this incredibly strong loyalty and engagement with their specific audience. It drives usage in a way few other platforms could achieve with that demographic.
But that sounds like a massive risk, too, if everything hinges on one person.
It's the perfect symmetry, isn't it?
Yeah.
That huge strength is simultaneously its single greatest weakness. An extreme, singular, key person risk. Meaning if anything negatively impacts Donald Trump's ability or willingness to be the platform's main content engine, his health, his focus, his posting frequency, anything the company's primary value driver could theoretically just vanish.
Wow.
And alongside that, you see no real cost advantages, no economies of scale kicking in, which is why they have these substantial ongoing net losses. The business isn't getting cheaper to run as it grows. Not yet, anyway.
You know, listening to this, it feels like maybe we shouldn't even be thinking of DJT as a typical tech company.
I think that's a really insightful way to frame it.
Yeah.
Maybe viewing it as a tech firm misses the point. It's arguably much closer to a single talent media enterprise.
Like a record label with just one star artist.
It's exactly like that. Its entire risk profile, its valuation, it all seems to hinge less on user growth metrics like a Facebook or a Google, and much more on the continued relevance and exclusivity of that one individual.
And just to hammer home the scale difference here, let's put some numbers side by side. DJT, $8.12 billion market cap, right? TTM revenue, maybe $8 million. Net income, negative $200 million. ARPU, like $1.
Painful numbers.
Now compare that to, say, X. Estimated $40 billion market cap, over 500 million users, $4.5 billion in revenue, ARPU around $8. Still losing money, but different scale.
Totally different league.
And then Meta, $1.2 trillion market cap, 3.2 billion users, $140 billion revenue, $45 billion profit, ARPU near $44.
Yes, yeah. The gap isn't just a gap, it's a canyon. It highlights this fundamental disconnect between DJT's market price and its operational reality.
Absolutely staggering. Okay, before we move on, just a quick reminder to everyone listening, like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, and remember, members paying just €4.99 a month get priority on deep dives for tickers they suggest. We're planning to cover all the S&P 500 stocks over the next few months, and members get first crack.
And if you just want one specific deep dive, dropping us a super thanks is the way to go. Okay, we've talked business model. Let's move on to the people running the show. Chapter 2. Evaluating the custodians of capital. Who's in charge?
Well, the CEO is Devin Nunes. His background is primarily, as you probably know, in politics and also agriculture.
Right. Not exactly a tech startup guru.
No. While he brings, certain connections and perspectives, there's limited direct experience there in scaling a tech or media company from this kind of early loss-making stage to being profitable and sustainable.
And what about the board of directors? How independent are they?
That's a key governance question. The board is largely made up of people with strong political and business ties to the majority shareholder, Donald J. Trump.
Which raises flags about.
Well, it raises questions about genuine board independence. Are they providing objective oversight for all shareholders, or is the focus primarily aligned with the controlling shareholders' interests? This is where you can get what's called an agency problem,
where management or the majority owner's interests might not align with minority shareholders.
Precisely. And transparency seems a bit unconventional, too.
Yeah, communication is often sparse. Sometimes it happens directly via Truth Social posts, outside the standard SEC filings. Plus, the whole SPAC merger process was quite long and involved SEC investigations, which adds to the overall governance risk profile. Okay, let's talk money management, capital allocation. They got a chunk of cash from the SPAC deal, around $150 million. Is that a war chest for growth or more like a lifeline?
That's the critical question, isn't it? Given the numbers, it looks much more like a lifeline. Their main use of capital so far has been funding those significant ongoing operating losses.
How fast are they burning through it?
Well, if the trailing 12-month net loss is around $200 million, that implies a quarterly burn rate of roughly $50 million.
So with $150 million in the bank.
That suggests a cash runway of only about 3 quarters, maybe until mid-2026, give or take.
Wow, that's not long.
Not long at all. Survival seems the immediate priority, not major expansion. It strongly suggests they'll likely need to raise more capital, probably through issuing more shares, which is dilutive to existing shareholders within the next, say, 9 to 12 months.
So more dilution potentially coming down the pike. And how effectively are they using the capital they do have? What about return on invested capital?
ROIC. It's deeply persistently negative. It's not just low returns. It actually indicates the business, in its current form, is destroying capital. Every dollar invested in operations is currently losing money.
Which brings us back to governance again. It sounds like the structure really favors the majority shareholder.
It certainly appears optimized for political loyalty and alignment with Donald J. Trump. For minority investors, you're essentially passive. You have very little, if any, real influence on the company's direction.
Okay, let's get into the nitty-gritty of the financials now. Chapter 3, a forensic looker. Look at the financial.
Right, let's lay out the stark facts. TTM revenue, about $8 million. Market cap, $8.12 billion. The contrast is just huge.
And while the percentage growth might look okay,
It's coming off an extremely low base. There's no trajectory visible in that $8 million revenue figure that remotely justifies an $8 billion valuation based on standard metrics.
what about profitability? Is there any light at the end of that tunnel?
Not currently visible. The profitability crisis is quite alarming. TTM net loss, around $200 million on that $8 million revenue. That works out to a net profit margin of negative 2,500%.
Minus 2,500%.
Yeah, it's extraordinary. This isn't typical startup burn. It shows expenses are just vastly, vastly outstripping sales, orders of magnitude higher.
So cash flow must be bleeding heavily too.
Deeply negative free cash flow, yes. It mirrors the net loss and shows they're burning through cash rapidly on actual operations. Let's look at the trend. FY 2023 revenue was $1.05M. Now TTM, it's $8. But the net loss went from $55M to $200 in that same period.
So more revenue, but much bigger losses.
Exactly. MAUs doubled from 4M to 8M, and ARPU went from 0 to 838 to $1, which is an improvement, sure, but the losses ballooned. They're spending a lot more to get those users and that revenue, and it's not paying off yet.
What about the balance sheet? Any saving graces there? Less debt, maybe?
Yeah, they do have low debt because the SPAC deal was equity funded. That cash gives them a strong current ratio, meaning good short-term liquidity. But, and it's a big but, that liquidity is finite and it's diminishing fast.
And they've never been profitable.
Never reported a profitable quarter. And based on current trends, there's no clear visible path to profitability.
Okay, valuation. This is where it gets really wild, right?
Yeah.
How do you even apply standard valuation metrics?
It's tough. PE, price to earnings, not applicable. Earnings are negative.
Right.
But price to sales, PS, it's astronomical. Over 1,000 times.
1,000 times sales.
Yes. $8.12 billion market cap divided by $8 million TTM sales. Just for context, mature tech giants like Meta or Google trade around 5x to 7x PS. Even super high-growth software darlings rarely sustain PS ratios above, say, 20x or 30x.
So 1,000x is off the charts.
Completely disconnected from any standard benchmark. It tells you the market isn't valuing this based on current sales or even near-term sales potential in a conventional way.
So what does an intrinsic value model, like a discounted cash flow DCF, suggest if you try to model out future cash flows?
Okay, if you run a DCF, the bear case where things don't improve much, intrinsic value hits towards zero. A base case assuming, moderate user growth, some ARPU improvement, maybe profitability way out in the future, you get an estimated value of maybe $1.50 to $3 per share.
$1.50 to $3, compared to $45 currently.
Exactly. And even a really optimistic, aggressive bull case, assuming rapid growth, international success, TMTG Plus becomes a hit even that only gets you to maybe $7 to $10 per share.
Still way below the market price. What drives that low valuation even in the bull case?
A huge part of it is the discount rate you have to use. We're talking a very high WACC, weighted average cost of capital, maybe 15–20%. That reflects the immense risk. Unproven model, that extreme key person dependency, political risks, regulatory risks, high volatility. It all gets baked in.
So the market clearly isn't using a DCF model. What is driving the price then?
It really seems the stock is functioning more like a political barometer, or maybe a tracking stock for Donald J. Trump's brand and political fortunes.
So price moves on political news more than financial results.
It correlates much more strongly with political events and sentiment around him, and the shareholder base is very heavily retail. Many are likely supporters who derive a sort of non-economic value or satisfaction from holding the stock.
And there was something even more fundamentally alarming you mentioned earlier about the basic cost of doing business.
Yes, The potential for negative gross margins. This is critical. It means the direct variable costs of just delivering the service, things like paying Rumble for hosting each user, could actually be higher than the revenue they bring in from that user.
So they could be losing money on every user even before paying salaries, rent, R&D, everything else?
Potentially, yes. If gross margins are negative, the fundamental unit economics are broken. You can't just scale your way out of that problem. It suggests the core business model as it stands might not be viable.
Wow. Okay, that's a deep dive into the company itself. Let's switch focus now to the market's view and the road ahead. This is part 2, market sentiment, ownership, and the road ahead.
Right, let's start with Chapter 4, reading the market's pulse.
Yeah.
How does Wall Street see this?
The perception seems skeptical.
Deeply skeptical, I'd say. What's really noticeable is the lack of coverage from major Wall Street investment banks. For a company with an $8 billion market cap, that's unusual.
Virtual silence from the big firms.
Pretty much. The few analysts who do cover DJT tend to have sell or underperform ratings and their price targets, often more than 90% below the current market price. We're talking low single-digit dollar targets like $2 or $3.
That lack of coverage, is it just an oversight or deliberate?
Oh, it seems quite deliberate. Firms likely view the stock as basically unanalyzable using their traditional financial models. Plus, covering such a politically charged and volatile stock probably carries significant reputational risk for them.
So it creates an information vacuum almost.
It really does. And that vacuum can amplify the meme stock characteristics because there are fewer institutional fundamental voices providing counter-arguments to the speculation. The financial media tone generally reflects this deep skepticism too, focusing on the valuation disconnect and the political entanglement.
What about quantitative indicators like short interest? What does that tell us?
Short interest is extremely high, around 20% of the available float. That's a clear, strong signal of deep bearish conviction from institutional investors, the ones who are actually betting significant capital that the price will fall.
But high short interest can also lead to volatility, right? The short squeeze phenomenon.
Exactly. It's a paradox. That large short position makes the stock highly susceptible to short squeezes. If the price starts rising, short sellers are forced to buy shares to cover their positions, which pushes the price up further, creating this upward spiral. It adds to the extreme volatility.
And technically, where does the stock stand?
Technically, it's a bit mixed. As of our analysis date, it's trading below its 50-day moving average, suggesting negative short-term momentum. But it's still above its 200-day moving average, so the longer-term uptrend, fueled by that speculative interest, is technically still intact.
Okay, let's move to Chapter 5, the ownership structure, a concentrated bet. Who actually owns DJT stock?
The ownership structure is highly unusual for a public company this size. Institutional ownership is exceptionally low, less than 5%.
Less than 5%. Who are these institutions?
Mostly passive index funds. Think ETFs or mutual funds that have to hold the stock because it's part of an index they track. There's a near total absence of traditional long-only institutional investors, the active managers who pick stocks based on fundamentals. They're staying away.
So who owns the vast majority?
The defining feature is the controlling stake held by Donald J. Trump. He controls approximately 65% of the company's shares.
65%, so complete control.
Absolute and uncontestable control over all major corporate actions, strategy, everything. DJT is what's known as a controlled entity. Minority shareholders have effectively zero say in practice.
And wasn't there a lockup expiration recently? What does that mean?
Yes, a really significant event was the expiration of the post-merger lockup period for insider shares, which happened in late 2024. This released a massive block of shares mostly held by insiders and early investors, including the majority shareholder, making them potentially available for sale on the open market.
That sounds like a huge potential overhang, a sort of Damocles.
That's exactly the term often used. This enormous potential supply of shares creates persistent risk for minority shareholders. Even a relatively small sale by the majority shareholder could exert significant downward pressure on the stock price, just due to the sheer volume involved.
So even though it's one class of stock technically, that 65% stake basically creates a situation like a dual-class structure where minority votes don't matter.
Precisely. It's a de facto dual-class structure. Minority shareholder voting rights are mathematically irrelevant. If you buy the stock, you're buying a non-controlling passive interest, and your investment outcome is largely tied to the decisions and actions of the controlling shareholder.
Okay, we've looked at the business, the management, the financials, the market view, the ownership. Let's try to synthesize all this in Chapter 6. A comprehensive risk and opportunity assessment, maybe using a SWOT analysis framework. Strengths, weaknesses, opportunities, threats.
Sure. Let's start with strengths. The big one is that unparalleled brand loyalty and engagement within its niche. Then there's the exclusive rights to Trump's social media content. They also have that cash position, which gives them a near-term runway, however short. And there is an established, albeit small, network effect among its users.
Okay, weaknesses. We've hit on a few.
Quite a few. The extreme key person dependency is paramount. The unproven and, frankly, ineffective monetization model, that low ARPU, massive operating losses, negative cash flow, lack of a proprietary tech moat relying on Rumble, and the governance structure prioritizing majority control.
And that really highlights the core paradox again, doesn't it? The strength is the weakness.
It's inescapable. The exclusive connection to Donald Trump is their biggest asset and their most severe risk. It makes the whole enterprise feel quite fragile, almost binary.
What about opportunities? Where could they go from here?
Well, there's potential for user expansion, perhaps if mainstream platforms tighten moderation further. They could try to leverage that captive audience for new ventures, like the TMTG Plus idea. International expansion is theoretically possible, and maybe exploring other monetization roads like political fundraising tie-ins or e-commerce.
And threats, looming risks.
Threats are significant too. Any adverse change related to Donald Trump health, public profile, political relevance, even just his posting habits could be devastating. That potential selling pressure from the majority shareholder we discussed is a big one. Intense competition from big tech isn't going away. Heightened regulatory scrutiny is always a possibility. And of course, shifts in the overall political landscape could impact them.
How do external factors play in, like interest rates or geopolitics?
Well, higher interest rates generally hurt companies like DJT, whose potential profits are far off in the future. It makes that future money worth less today and makes borrowing more expensive.
Standard finance theory.
Right, but geopolitics is where it gets weird. Take something like, hypothetically, new U.S. tariffs being imposed in 2025. For most companies, that might be bad news.
Trade wars, uncertainty.
Yeah. But for DJT, it could paradoxically be positive. Why? Because it fuels political debate, polarization, conflict, the very things that tend to drive engagement on their platform.
So it's kind of counter-cyclical, but not to the economy. Counter-cyclical to stability.
That's a great way to put it. The company seems to thrive on instability, on political and social turmoil. That kind of environment can actually be a tailwind for user engagement, making it a very peculiar asset.
All right, we've covered a huge amount of ground. Let's bring it all together in Chapter 7. Conclusion.
Okay, synthesizing all this, you basically have two completely opposing narratives for DJT.
Narrative 1, the bull case.
The bull case isn't really built on traditional fundamentals. It's a bet on the power of a very unique brand, that direct political connection, and the idea that maybe somehow they can monetize this loyal, captive audience. It treats the stock almost like a tracking stock for a political movement. It's about intangibles, sentiment, brand power.
And the bear case.
The bear case is overwhelmingly rooted in a disciplined, fundamentals-based assessment. It points to a valuation that seems totally detached from operational reality, a business model that looks structurally flawed, maybe even broken at the unit economic level, existential key person risk, the looming threat of insider share sales, and governance issues that disadvantage minority shareholders.
So let's just recap the valuation gap one last time.
Current share price, $45.10. Our base case intrinsic value estimate, $1.50 to $3 per share. Even our optimistic bull case estimate, only $7 to $10 per share.
The gulf is just enormous.
Undeniable. The conclusion seems pretty clear from a fundamental perspective. The market price appears driven primarily by sentiment, political affinity, and speculative meme stock dynamics, not the underlying business performance or prospects.
Which means, for an investor focused on fundamentals,
there is simply no margin of safety at the current valuation. The price is far, far above any reasonable estimate of intrinsic worth based on the financials and observable business realities.
So the final question lingers. What does it really mean when a company's market value just completely detaches from its business fundamentals like this? How do we, as curious, informed people, navigate this landscape where maybe emotion or loyalty or politics seem to drive investment choices more than numbers?
That's the big question, isn't it? Something to really chew on.
Definitely food for thought. And if you found this deep dive useful, please do like and subscribe to Stock Analytics AI on YouTube. It really helps us out.
And don't forget, members get priority on deep dives for just €4.99 a month. We're tackling the whole S&P 500 soon, and members get that exclusive access. Plus, you can suggest stocks in the comments.
Or drop us super things if you want a specific one-off analysis. Now, the important disclaimer.
Yes. Please remember, This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice. Always do your own research or, better yet, consult with a qualified financial advisor before making any investment decisions.